Today, we will discuss the so-called house hacking trend and tips to ethically and legally minimize federal income taxes. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the firm Cummings and Cummings Law. I also teach business law at Florida Gulf Coast University and hold 4 degrees, including 2 law degrees, as well as a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my law practice. Our firm website is www.cummings.law. House hacking has become a popular real estate strategy, particularly as home prices and interest rates have risen. By renting out part of a primary residence, whether a spare bedroom, a basement unit, or a duplex, homeowners can potentially offset their mortgage costs and build equity simultaneously. However, this hybrid approach to home ownership brings unique tax implications that differ from both traditional home ownership and real estate investing. House hacking is the practice of living in a property while renting out part of the property to generate rental income. The rental revenue can help cover mortgage payments, property taxes, and other expenses, effectively reducing the cost of home ownership. With mortgage rates higher than they have been in quite some time, house hacking has become a method for buyers to afford homes despite increased borrowing costs. At the same time, elevated housing prices make house hacking an appealing way to reduce monthly out-of-pocket expenses. The tax benefits are also attractive, as house hackers can take advantage of deductions typically reserved for rental properties. While rising interest rates have slowed traditional home purchases, house hacking remains attractive because it potentially allows buyers to afford more expensive homes than they otherwise could. Some buyers who might have waited for rates to decrease are moving forward with house hacking as a financially viable option. From a tax perspective, house hackers enjoy a unique combination of benefits. On one hand, the portion of the home utilized as a personal residence qualifies for standard homeownership deductions. On the other, the portion rented out is treated as a rental property and qualifies for rental property deductions. For the personal portion, homeowners who itemize can deduct mortgage interest of up to $750,000 of debt or $375,000 if married filing separately or filing as an individual. Property taxes are deductible as part of the $10,000 cap on state and local taxes, though this cap does not always apply to the rental portion. For the rented portion, depreciation becomes a major advantage. The structure, though importantly not the land, can be depreciated over 27 and a half years. To put that in perspective, if you rent out half of your home, you may depreciate half of the building's value over that time period. Repairs and maintenance related to the rental area are fully deductible, as are any utilities you pay on behalf of your tenants. If you utilize part of your home exclusively for business purposes, such as a dedicated home office, there may also be deductibility options there. As an example, suppose you own a fourplex, live in one unit, and rent out the remaining 3. In that situation, you may deduct 75% of your mortgage interest, property taxes, repairs, insurance, and other shared costs as rental expenses and apply the usual Schedule A rules to the remaining 25% which you personally occupy. When you eventually sell the house-hacked property, the tax treatment becomes more nuanced. Section 121 of the Federal Internal Revenue Code allows a homeowner to exclude up to $250,000 in capital gain or $500,000 if married, filing jointly on the sale of a primary residence. The key requirement is that the owner has lived in the home for at least 2 out of the previous 5 years. But for house hackers, this exclusion only applies to the portion of the property used as a primary residence. The portion used as a rental must be reported as an investment property, therefore is subject to capital gains tax. Furthermore, any depreciation taken on the rental portion may be subject to recapture rules and taxed at a flat 25% rate. Consider a situation where someone purchases a duplex for $400,000, lives in one unit, and rents out the other. After 5 years, they sell the property in our hypothetical case for $600,000. The $200,000 gain is divided in half. The $100,000 from the unit they lived in qualifies for the Section 121 exclusion and is tax-free. The $100,000 from the rental unit is subject to long-term capital gains, tax, generally 15 to 20%, and any depreciation taken must be added back as depreciation recapture, taxed at 25%. Taxpayers looking to maximize the tax-free portion of their gain sometimes convert the entire property into a primary residence for at least 2 years prior to selling. This strategy can increase the amount eligible for exclusion, but it must be planned carefully and timed correctly. When comparing house hacking to house flipping, both involve real estate as an investment vehicle, but the time horizon and tax treatment are fundamentally different. House hacking is a long-term strategy, often spanning several years or longer, with ongoing rental income and gradual appreciation and depreciation. Flipping, by contrast, is typically a short-term play. The investor purchases a property, sometimes renovates it, and sells it quickly, usually within 1 year. The benefits of house hacking include passive rental income, tax deductions for depreciation, as I mentioned just a moment ago, and repairs, and eligibility for the Section 121 exclusion on the personal portion. However, it does come with the responsibilities of being a landlord, including tenant screening, maintenance requests, and potential disputes. Many new house hackers underestimate quite significantly the time and emotional energy required to deal with tenants, especially when living in close proximity. Flipping, while free of long-term tenant management in many cases, offers no capital gains exclusion if the property is sold within 1 year. Profits are taxed as ordinary income, which can result in a substantially higher than expected tax bill. Additionally, the investor has no opportunity to claim depreciation deductions because the property is never rented. Flipping also entails higher upfront costs such as contractor fees and materials, and carries the risk of market changes during the renovation timeline. For example, someone who purchases a distressed property for $200,000, invests $50,000 in renovation, and sells it 6 months later for $300,000 may appear to have made a $50,000 profit after costs. But this is where the fun part comes in. And of course, I'm speaking facetiously. This entire amount is taxed as ordinary income, potentially at a higher marginal rate. Therefore, the total net amount of income will be substantially lower than that $50,000 profit. By contrast, a house hacker who purchases the same house and lives in one part whilst renting the rest could depreciate the rental portion, claim deductions for repair expenses, and, if held for more than 2 years, potentially exclude some of the capital gains from tax entirely. In conclusion, house hacking remains a strong strategy for homeowners seeking to reduce housing costs, build long-term wealth, and benefit from favorable tax treatment. While it lacks the quick payoff associated with flipping, it provides stability, recurring income, and access to deductions that can make home ownership more affordable. Before making a decision, individuals considering house hacking, or its cousin house flipping, should speak with a qualified attorney and tax advisor to ensure that they are properly structuring their investment and complying with all applicable tax rules. With the right planning, house hacking can be an efficient and effective path to financial independence. Again, my name is Chad Cummings, and I hope you found this information helpful. Should you have any questions regarding this video or the content of any of my earlier videos, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.